Welcome to class, students. Today at the Module 6, we'll be looking at insurance laws in North America. Insurance laws in North America. Module content: Introduction, Historical contents, State-based regulatory system, Regulatory approaches by state, National Association of Insurance Commissioners by key National Association of Insurance Commissioners models, and limitation of National Association of Insurance Models (NAIC). So we're looking at introduction, historical content, regulatory approaches by state, National Association of Insurance Commissioners, key NAIC models, limitation of National Association of Insurance Models (NAIC). So we're looking at introduction, historical contents, and state-based regulatory system, regulatory approaches by states, the National Insurance Association of Insurance Commission, the key NAIC models, and the limitation of National Association of Insurance Commissioners. Introduction: United States Insurance Regulatory Framework. Well, we're going to be looking at the MC Karan Ferguson Act 1945. MC Karan Ferguson Act represents the foundational statutes governing insurance regulation in the United States. This federal regulation exhibited the principle that insurance regulation is primarily a state concern, while the key provisions are state regulatory primacy, limited federal antitrust exemption, reverse preemption and boycott exemption, while the state regulatory primacy declares that the business of insurance and every person engaged therein shall be subject to the law of the federal state, that is 15 USC dollars 1012A. Limited federal antitrust exemption provides a partial exemption from federal antitrust laws, that is Sherman Act, Clayton Act, and the Federal Trade Commission Act when states regulate insurance. While we also have the reverse pre-exemption. Federal laws do not preempt state insurance law unless specifically intended to regulate insurance. Boycott exemption. The antitrust exemption does not apply to act of boycott, coercion, or intimidation. 15 USC dollar to 1013B. Also have the contents. The act was passed in response to the Supreme Court decision in the United States versus Southeastern Underwriters Association, that is 322 US 533 1994, which held that insurance was interstate commerce subject to federal regulation under the Commerce Clause. Congress reversed this decision to preserve the existing state-based regulatory system. We have the modern relevance. The MC-Ferguson Act remains controversial with periodic calls for reform or repeal. Critics argue it permits anti-competitive practice, while supporters maintain it allows for tailored state-based regulations. I want to have the look at the state-based regulatory system structure. Each of the 50 states plus the District of Columbia and US Territory maintain its own insurance department headed by an insurance commissioner or superintendent. The state regulatory powers are licensing and solvency, rate regulation, policy form approval, market conduct examination, financial examinations, and guarantee for the administration. We also have licensing and solvency, authority to license insurance agents and brokers. We also have rate regulation, power to approve, modify, or reject insurance rates, varies by state and line of business. We also have policy form approval, review and approval for insurance policy language, market conduct examination, oversight of business practices, and customer and consumers protection. We also have financial examination, regular assessment of insurer financial condition, then guarantee fund administration, management of state guarantee associations. Have the approaches by states. We have the prior approval state, the file and use state, the use and file state, no file state. In the prior approval state, rates must be approved before use, that is Florida and New York. The file and use state, rates filed with regulators and can be used immediately. Use and file state, rates used first then filed with regulators. We have no file state, limited regulatory oversight of rates, primarily commercial lines. We also have state specific variation. California preposition 103 requires voter approval for rate increases, while the Massachusetts highly regulated onto insurance market with fixed territory. We have Texas separate regularly framework for different insurance types. National Association of Insurance Commissioners (NAIC). The NAIC was founded in 1971, serves as a coordinating body for state insurance regulators. Function of National Association of Insurance Commission: we have model law development, accreditation program, financial regulation standard. We have model law development, create model regulation and legislation for state adoption. Accreditation program certifies state insurance departments meeting minimum standard, while financial regulation standard develop uniform financial reporting, requirement. Information system maintains database including state-based system for financial data, system for electronic rate and form filing. Also have that is SERFF. Also have producer database DPD for licensing and regulatory information retrieval system, that is IRIS. So we have key models. We have Model Holding Company Act, Risk-Based Capital Requirements, that is RBC, Model Unfair Trade Practice Act, Annual Financial Reporting Model Regulation, Credit for Reinsurance Model Law. Model Holding Company Act requires registration and reporting of insurance holding companies. Risk-based capital requirement establishes minimum capital standard based on risk. Model Unfair Trade Practices Act prohibits deceptive insurance practices. Annual Financial Reporting Model Regulation, standardized financial reporting and credit of reinsurance model law governs reinsurance transactions. So these are the key models: the Model Holding Company Act, Risk-Based Capital Requirements, Model Unfair Trade Practices Act, Annual Financial Reporting Model Regulation, and Credit for Reinsurance Model Law. So we want to look at the limitations of National Association of Insurance Commissioners (NAIC). The NAIC has no regulatory authority. States must independently adopt its models, leading to non-uniform implementation. The Affordable Care Act (ACA) 2010, the Patient Protection and Affordable Care Act, represents a significant federal intervention in health reinsurance regulation. Major insurance provisions are a consumer protection, guaranteed issue, community rating, essential health benefits, preventive services, dependent coverage. Also have annual and lifetime limit prohibition. The guaranteed issue Insurance must offer coverage regardless of pre-existing condition, while the community rating limits premium variation based on age, geography, tobacco use and family size. We also have the essential health benefits, requires coverage of 10 categories of health services. Preventive services mandate no cost coverage for preventive care. We also have dependent coverage, allows children to remain on parent plans until age 26. They have the annual and limit prohibition, bans dollar limit on essential health benefits. Thank you for listening.